Hi everyone, welcome back to Be Rich. I hope you had a wonderful Saturday evening and you rested well through your Sunday, and now you're ready to get back into your work week tomorrow, which is Monday. Yes, we're already well into April, and this is the second week of April, and there's much to do in terms of investing in different coffee ranges. Yesterday, I spoke about the shortcut method for the discounted cash flow. And today I wanted to talk about another favorite ratio which investors use, which is known as the PEG, or the growth adjusted PE, or named after the famous Peter Lynch, known as the Lynch ratio. What you do here is you take the PE ratio and you divide it by the growth rate, and if the Lynch ratio is less than 1, it's considered to be a very cheap stock, and if it's 1, it's considered the market is valuing it correctly to its growth rate, and if it's more than 1, is considered to be an expensive stock. The market is paying too much for it. So this is the main thing. For an example, if the market is PE is 10 and the growth earnings is 15%, that is 0.66. That means it's a steal. If it's, let's say, the PE is 15 and the growth rate is 15, the ratio is 1. So that means you're paying pretty much the right price for it. And let's say the PE is 30 and the growth rate is 10. The ratio is 3. That means you're paying too much money for the stock because the growth rate is very slow compared to its PE. So this is what it means. A simple analogy of this would be, let's say you're buying a scooter which costs you 60,000 rupees and gives you 60 kilometers per liter. That means you're paying 1,000 rupees per kilometer per liter. If you have another scooter which gives you 40 kilometers and costing you 80,000 rupees, that means you're paying 2,000 rupees per kilometer per liter. So the Lynch ratio is literally like that way of analyzing. I know the scooter's analogy might be confusing, but like what I first said, it's a very simple ratio. And if it's below 1, if it's equal to 1, and if it's above 1 is what you have to keep in mind. So why is this useful? This is useful because many high growth companies may look expensive, but if you see the growth rate in their PE and you adjust the PE with their growth rate, then suddenly you can see it may be undervalued or it may be overvalued. So it is bringing the growth, so-called the future earnings potential of the company into consideration. But there is a problem in this ratio. The fundamental problem is it works for companies which have stable and predictable growth rates. If this company has a stable growth rate, when you look over a period of 5 years, 10 years, you see a stable pattern in growth and it's predictable growth, then yes. So there are companies like that. I'm not saying which ones, because then you'll think I'm talking about those companies and you should invest in those companies. You can do your research and you can find these out. And another problem is you're using the earnings per share. So you at least should have 3 to 5 years to be safe. If you don't have, you cannot use this equation at all. And you should definitely avoid companies that are cyclical or loss-making companies, because this number can be very misleading if you look at it. So this is the basic premise of PEG, growth adjusted price to earnings. So let's talk about some examples now, real world examples. Yesterday we spoke about ITC, so I'll take ITC into this. Its PE ratio, April 2nd, 2025 is 25.32 approximately. Its earning growth rate for the last 5 years, it has an average of 9.8 per year. So the PEG ratio for ITC is 25.32 divided by 9.8, which is 2.58. So this ratio is above 1. So since it's above 1, this is considered to be overvalued according to this ratio. I'm not saying ITC is overvalued. Please don't get confused. I'm just talking about applying this methodology to see if it's overvalued or undervalued is one way of looking at it. Is it the best way? No. Is it a way? It is a way. So you have to choose. Like I talked about the shortcut discounted cash flow yesterday, there's another way you can look at it. Let's take the second company, right? Tata Consumers, which we spoke about yesterday. Their PE ratio, April 3rd, was 89.8. Their earnings has been around 16%. So 89.8 divided by 16, which is 5.61, right? That means their PE ratio is well above 1, so it's considered very expensive. So this is the way to analyze it. Even if you take the price to earnings of ITC and divide it by the growth rate of Tata's Consumers, a hypothetical company, that will still be above 1.6. So it really doesn't give too much details, but it's a quick way of seeing. But you have to do a little more diving into it, is what I said. This is a great way to see initially, if you're going through a whole bunch of companies, 100 companies, if you want to look at the PEG ratio, you can just look at the PEG ratio column and see, okay, these are all close to 1. That means they're coming to value, or they're below 1. You can say, okay, they started becoming of value. But do keep the trap in mind. Trap examples would be something like Tata Steel. Tata Steel, okay, had a bumper year and the earnings grew by 80% last year. So the PE is 6 divided by 80, the growth rate, and the ratio is 0.075. It looks insanely cheap. But this 80% bumper year is not sustainable. Global steel prices, the tariff war, all this put together, and the cyclical nature of steel industry itself, these earnings can become negative and can, sharply change. So you cannot bet on this growth consistently. That is an example of consistency. Now let's talk about another one where you don't have enough data. For example, we talk about Zomato. A lot of you think Zomato is a great company, and if you take the PEG ratio over there, the PE is 500, right? But the profits has grown by 100% from 0.5. The EPS growth has gone to 1 rupee. So that's almost double. That's 100%. So if you take 500 divided by 100, and it's 5, and looks expensive, but the base is too small. The company has not been around long enough for you to understand it. So it's very distorted because the PEG ratio, there's not enough to know what is going to happen. So you need large amounts of data for PEG ratio. It has to be stable, it has to be consistent, and it should be predictable. So if these things are met in that company's business, then you can look at that business and say, okay, this business is something which is stable, it's predictable growth rate, and it has a long history. Then you can use a PEG ratio. So what would be a great example for PEG ratio is your fast moving consumer goods, which is your FMCG, because there's stable demand. People need essentials no matter what you need to eat. So you need your atta and rice and pulses, right? Predictable earning, that means the recurring purchase and cash flow is consistent. Reinvestment opportunities like advertising, distribution, all that is predictable. Long-term operating histories like HUL, Nestle, Colgate, they've been there for decades. So you have a lot of data to go through and see. And the moderate steady growth rate. Most of them have a growth rate of 8 to 15%, like I said, Tata Consumers was 16%. And there's no major shocks to the economy in terms of export, and anything happens globally also. It's not like a major shock because, like I said, consumers need to continue eating and using the products. So that would be an example where you can use the PEG ratio. Should you use it or not use it? I leave it up to you. I would love to know, which companies do you think we should apply these to? Which industries do you think we should apply this to? Which sectors? Put it in the comments. I want to hear what you think about this. I'm there, like I said in the previous video, on Instagram to have further discussions about it. Is there any company which we should have used PEG ratio and should have seen value in it? Let me know. I'd love to learn more from you too. Thanks for watching the video. I hope you had a wonderful Sunday and a weekend, and I wish you a wonderful week ahead and hope it's productive. Do remember, every opportunity to invest in the market, try and throw a little bit of different coffee in so it keeps us chugging along in our year-long quest. And that's also going to turn into a 10-year quest. Hopefully we'll all be around 10 years from now to enjoy the fruits of all this labor. Thanks for watching Birich again. See you again soon. Bye.